Hi, welcome to MyWealth.com. I'm Mike Conlon. I'm one of the senior instructors with the courses. Welcome to today's blog. Today's blog is entitled Earnings and Unemployment. Alright, so we're in the midst of earnings season right now, and the market is responding in typical fashion. Alright, in one of my previous articles earlier this month, I talked about some of the things the market needed to see from earnings season in order to stabilize and move higher. Well, guess what? We're actually seeing them. But now what? Alright, so as a result of these earnings surprises, the S&P 500 index is at 8-month highs. But is anyone really surprised by these earnings announcements? I mean, really, the bar has been set so low in terms of analyst estimates that even the most inept of CEOs could guide his company over these hurdles. Alright, so is anybody else concerned about this? Well, apparently Morgan Stanley's equity strategist is. Alright, he says that investors should be selling into this rally as it has no legs. Alright, now normally, when I see one of these analyst predictions, I would be thinking maybe I should do the opposite of what he's saying. But this time may be a little bit different. Okay, because one of the reasons this rally has no legs is because the companies that are beating estimates, even though they have declining revenues. Okay, and that the other reason that that companies are beating these earnings is directly related to unemployment. Okay, let's take a look at what this means.
As always, be sure to check out the written blog at www.mywealth.com/blog. Okay. Companies are becoming leaner due to mass layoffs. All right, by reducing their labor costs, companies are able to increase their profitability even though they're not bringing in as much revenue. All right, some of these companies include Starbucks, Ford, and Caterpillar. You could also throw Intel into that mix, just to name a few. All right, but is this a good thing for the economy and for the stock market going forward? Not at all. Why is that? Well, because all companies are doing right now is showing us that they can cut the fat and that they can reduce their labor costs, which will allow them to be profitable. Okay, but companies are good at cutting the fat, not growing their businesses. All right, so when you're thinking about when stocks are going up, okay, you really want to have some forward-looking growth prospects going on there. Otherwise, why would you want to be in that stock? And the problem is that with the stocks rising recently because of these earnings, people are anticipating that there's going to be some growth there. But right now, all they're showing is that they're not growing because revenues are declining, but rather that they're just cutting their expenses. So at this point, we're not really certain if it's a good time to actually be in some of these stocks. But we'll take a look at that as we're going forward. Okay, so by cutting the fat, higher unemployment means a reduction in consumer spending. Think about it. Maybe you might not want to think about it, but if you were somebody who lost your job, would you just go out and spend right away? No. You'd probably be looking to cut your expenses and to do as much saving as possible. Okay, and also if you are somebody who didn't lose their job, okay, but you see all these other people that are losing their job, you got to be thinking to yourself, one, hey, I'm pretty lucky to actually have a job, but two, maybe now is not a great time to be spending, and maybe I should be thinking about saving in case I'm someone who loses my job as well. All right, so then what that does is that continues to downward spiral through the economy. Okay, so basically, people are saying, well, gee, we don't want to spend now because of all the turmoil and all of the uncertainty regarding what companies are going to do with their unemployment numbers. Okay. And if the employment continues to increase, what that's going to do is that's going to reduce consumption. Okay, and when you have reduced consumption, all right, that means that people aren't spending as much money. That means companies aren't making as much money. Okay, and if they're not making as much money, that means that their revenues are going to decline even further, which means next time down the road, they may have to cut more jobs in order to meet these economic numbers. Okay, so while unemployment is slowing, okay, we still have huge jobless claims out there, and these are pretty big numbers that historically we're talking about. So, in that regard, corporations that are slashing the workforce, they're actually contributing to their own demise. Okay, because what they're doing is by laying people off, they're cutting off a potential consumer for their business. Okay, and that means that the next time that they need to make numbers and earnings so they can get some pop in their stock price. All right, they may have to slash even more people. So, that's not really too great for the economy, nor for the stock market going forward. Okay, so don't wait. Get educated, get in a course. Come to www.mywealth.com and find out how the economic climate can really affect your investments.
I would have much rather seen companies not beat their earnings but retain employees rather than slashing their workforce in order to gain a few bucks in their stock price. Okay, for the near-term prop and price they're experiencing now will be short-lived, okay, especially if there's no one left who can afford to purchase their goods because they are unemployed. All right, unless that company happens to make government cheese. All right, but that's a whole nother story. Okay, so if the equity markets can ride out this wave and unemployment starts to improve significantly, then I think we can justify these current levels. Okay, but if not, I expect the equity markets to sell off. That's going to include NASDAQ, the QQQQ, the Dow, DIA, and the S&P 500 SPY ETFs. And I'll also be looking to purchase the US dollar ETF, the UUP, as the flight to quality trade will be back in vogue. All right, so I'm just hoping right now that the rest of the market doesn't catch on, or that they're just too blind to see that these earnings are really forecasting more bleak times, okay, not prosperous ones. All right, so to learn more about how the economic climate can affect your investments, check out our brand new ETF course or our currency course. Okay, so I'm Mike Conlon. Thanks for being with me, and I will see you in the courses.